Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. If you watched our first video from this morning, you saw us do some math. And what you really saw in that math is higher rates is going to slow down real estate. So Matt, Mr. Lumberjack, I want to say right now that I believe higher rates on the 30-year mortgage are actually a good, if not a great thing. What do you think about that? Am I just all wet and wrong, or what's going on?
I like higher rates.
Yeah.
They're better. They're just better. I mean, we need something to start to temper inflation. Like we actually even care that that's a thing.
Right.
I mean, it's going to be a problem. It's already a problem.
Mhm.
I talk to my tenants and they're just like, yeah, things are tight. And it's welcome to, I mean, I know gas is over $5 a gallon where you are.
Yeah, 5.5. They're calling for $7 gas by the summer, perhaps.
That's nuts.
It's like
it's like 3.5 here. So
yeah,
but we have heating oil. So heating oil here is very expensive. Heating oil right now, I mean, we're $1.25 more expensive than we were last year. So
wow.
Yeah. So I higher rates are better.
Yeah, higher rates, basically what we have suffered through for 2 years, because again, you and I watch our markets every day. We write offers all the time. We've seen a lot of dumb money.
Yeah.
Right. And again, I've been, I was an accountant out of school, and I've been a part of acquisitions, both on the buy side and as the seller. And when debt is essentially free, there's a lot of bad business decisions that go on, a la Peloton. I don't know if you've been tracking that wild ass story. But they were the darlings of the shutdown, and now they've had to basically remove their CEO, and the new CEO is like, well, you got a little high on your own supply and you spent money on things you shouldn't have, and blah, blah, blah. And I'm like, damn, I remember those times. So yeah, I think I higher rates will, it'll stop the dumb money. It'll stop the dumb deals. And let's be very clear, in the real estate game, I don't think there's a lot of dumb deals being done in residential because of the fixed 30-year fixed. I think there are some just horrendous deals being done in commercial financing with bridge debt, short-term debt, IO loans, bad assumptions. And I'm looking to pick some of those up in 12 to 18 months.
Don't disagree with you. I was just going to say, that's what a lot of this dry powder. I mean, I know that the largest that you've owned is a 20 unit. Mm-hmm. The largest that I've owned is a 12. In the next 18 months, that might not be the case anymore.
No, I would love, absolutely.
There might be that opportunity to own a decent, significant building and be able to get it from a bank that says, yeah, all their numbers were off. Everything was way, way, way too low a cap rate that they were counting on. They were counting on way too much appreciation. They were counting on way too much rent appreciation. Yeah. And so we're just looking for somebody that can get in this game, work through it with us, because they still had some capital in the deal. But yeah, Mike, some of the stuff that's trading around me on the commercial side is nuts. It's nuts.
Yeah. And again, just be clear. I just like when I sold houses in 06, I sold about a year early. I sold some apartments in 19. It was clearly a year, maybe even 18 months early, but I don't feel bad that I sold them. It's just, who would have guessed the Fed would have brought rates to this low, and all these, lending products would have been around. But I look forward to stepping back in and buying some bigger units, but it will take time, and banks will reset and cap rates and all of these things. But I think higher rates are a good thing. Higher rates are going to show who is a good operator.
That's right.
There have been a lot of folks that got lucky, and the people that bought the properties from me, and one of them's already traded. They sold it just over a year, made a couple $100,000. You got lucky. And, but that's okay. Take the money and run. But yeah, higher rates are a good thing. It will just slow everything down. And it does. Yeah.
It'll take a lot of, the one thing that's interesting to me, and I got asked a great question on my live stream on Sunday, was somebody asked if they thought in the future months that with what was going to happen in the economy, that rates, or that being a cash buyer would get better. And I said, my answer was no. And my logic behind that is, I think cash buyers right now, 21% of homes being sold, single family homes, are
Mhm.
being purchased by investors, 21%.
Wow.
But 75% of those 21% are cash buyers.
Hmm. Okay.
So if if Washington does something stupid like they're really good at,
Mhm.
and they say, hey, we're going to not allow investors to purchase anymore, they're really the only people that they're taking out are the people that need a loan to purchase.
Right.
Well, that's only 6% of the single family homes being purchased right now, but our investment that need a loan.
Got it.
Right.
Yeah.
So the challenge I think that there is that, yeah, for guys that have stored up cash, or for, like the Wall Streeters, Mike, there are so many hedge funds buying houses in Florida right now.
Yeah.
I had a buddy of mine just sell his house to a hedge fund. He goes, weirdest thing ever. And I go, nuts. And the funny thing is I think he paid $370 for that house out just outside of, I think in Tampa, $370 for that house. And 13 months later closed at $530.
Wow. 50% profit
to a hedge fund.
And they just come in to close it cash. They're just done, right?
Done. That's it.
And now the hedge fund's going to keep it as a rental, I would assume.
I think so. Yeah. Yeah. Yep. But even that rental, it's like, but the numbers on that, right? Where it changes the game. And this is what people need to understand. The $540,000, $530,000 to the hedge fund, they don't give a crap. It's $530K. It's nothing. It's cash. So what are they doing? They're buying an asset for $530,000 in cash. And over the course of the year, even if their rents are $2,500 or $2,600 on that house, it's $30,000. So they're looking at 530, and the fact that they're going to get $30,000 return on $530,000, which is about 6%.
Yeah. Yeah.
That's what they're happy with, because they're getting 6 points on their money. They're not putting it in the stock market. They're not using it in the market. They're saying, we're diversifying. We're getting some additional assets. We're okay at 6 points on that asset, owning the asset. And what I've also seen is that these hedge funds, when they do these rentals, they put on a ton of fees.
Oh, of course.
Yeah. It's a ton of fees.
Yeah.
Every little thing's a fee. It's not like renting from a landlord. So it's going to be interesting to see.
Yeah. Hedge funds are clearly, that's their best risk adjusted return. Ending last year was a 6% single family home. It'll be interesting to see if that changes, right? Yeah. We take the Fed's fund raise to 2. I mean, does it clean the clock of tech companies, and then hedge funds go buy distressed assets? 2022 is going to be a messy year. And I do think it's because interest rates are going up. But again, higher rates are a good thing. Higher rates are going to slow everything down.
Yep.
Higher rates will mean less transactions, which again, all of these things I think are net positive, because the last thing you want is interest rates with a 2 on it and just runaway price increases. It's the time has come for 4.5%, 5% 30-year money, in my opinion.
Yeah, now's the most important time to be educated and prepared for what's about to happen in the market.
I couldn't have said that better. Something I said in the daily financial news when I ended it today is, today's the day to get ready. Right. Yeah. I talk about in my course 60 days to do the work, all of those things. You spend the next 60 days, maybe 90 days getting ready, so you don't have to get ready when the opportunity comes in the summer, because higher rates are going to slow things down. We go from 4 to 6% unemployment. We're in a recession. Motivated sellers will suddenly not be so hard to find. They will be waving their hand saying, hey, let's make a deal. So I'm excited by what's coming.
Me too. I mean, I've seen it this week in my market. I'll probably have to do a video talking about how my market inventory doubled in 1 week. It went from 3 to 6.
I'm telling people, write down your buy box. Watch it move. It is happening right now.
And the 3 that were added were, quite frankly, they're going to go under agreement, but I know a couple of the owners that are selling them, and they are profit taking. They are taking massive, massive profit. And they're just like, all right, might it squeeze a little bit more? Kind of like what you guys did, what you and Olivia did, right? When you didn't sell at the absolute peak, but you sold right in that last,
the last little bit. Yep.
That last mile. And that's what, we're looking at too, but the funny thing is like, still for us, a lot of those deals, they were still double-digit returns. They were
Mhm.
still 10, 11, 12% returns. And for us, we just got too used to 20 and 30% returns. And so we're not going to do a good
Yeah.
deal.
Yeah, exactly. It's always a great day to do a great deal. These are not great deals, right?
Mm-mm.
And more importantly, it is a sign, folks. I've been telling you
Yes.
this is coming. Get
Yep.
your buy box, do the work, do the
Yeah.
daily discipline. Inventory will be growing. The media is just all wet. I've been doing this for 20 some odd years. It is coming and I'm so excited. So
It
Matt,
is. It'll be a good time.
how can people find you?
Lumberjack Landlord on YouTube and Lumberjack Landlord on Instagram. It's daily tips for landlords, for those that self-manage or just need to recognize that they're not the only landlord going through something nutty that day.
There you go.